All right, everyone. I guess we can start at this point. Good morning. This is Mark de la Paz from FX Instructor. We're here to cover the ECB rate decision. Is it really something that is likely to move the market? That's really a big question that I have right now. Why? Because all the indications that I've seen over the last few weeks suggest that the ECB will likely retain its current rates. The ECB has already put in place the necessary measures that distressed European economies can tap in case it runs into trouble. So from that perspective, we do not expect to see any announcement or any new facility or any rate cut from the ECB. At the same time, we did hear from Mario Draghi yesterday. And what did Mr. Draghi say? He said that the credit crisis, the debt crisis has started to impact Germany. This is, to me, a significant news because Germany, after all, is the main, the biggest economy in the Eurozone, basically the backbone of the Eurozone. And it basically pays for the biggest chunk of the bailouts that occur in the Eurozone. So if Draghi's observation that, and indeed it is true that over the last couple of days, over the last few weeks in fact, we have been seeing poor data out of Germany. So if indeed Mr. Draghi is that concerned, does that mean that he has a rabbit off his sleeves? Will he be pulling a trick in today's ECB meeting? So I'm not quite sure how to put yesterday's speech, yesterday's statements by Mr. Draghi into context. Was it just meant to communicate to the German public the need for greater integration and the need for them to give up some more? Or is it really Mr. Draghi saying, hey, politicians, do something because I can't do anything anymore? If it is the former, then I would look for some surprises out of the ECB later. Whatever that surprise is going to be, it will likely mean that I should look for a weaker currency. The only case that I can think of here that the ECB can really do and have an impact in the economy would be to do the kind of quantitative easing measures that the U.S. has been doing. Basically, you print money and you not sterilize the additional money that you provide to the market. Because right now, the ECB's programs are designed in such a way that if someone asks for a bailout, they will be given the funding, but it will be sterilized. All right, so let's talk about the expectations again. As far as the rate announcement is concerned, we do not expect any rate cut at this point. If ever there's going to be a rate cut out of the ECB, it will likely happen only in the first quarter next year. Okay? They're not in a hurry to cut rates. As far as inflation pressures are concerned, the ECB continues to say that inflation in the Eurozone remains transitory. meaning it will go back down on its own. It did a while back, but I would point out that lately that CPI data in the Eurozone has been pushing back up again. I wonder just how long the ECB can ignore it, given that the Germans certainly do not want any inflation to enter the Eurozone economy, do not want the runaway inflation. Inflation is okay if it's less than 2%, but once it picks up above 2%, that's a problem according to the definition that the Eurozone uses. What else? Here's something that may be a target or an objective of Draghi's statements yesterday. Expectations for a banking supervisory authority for the ECB still calls for that happening within 6 months to a year. People outside of Germany want it to happen earlier than that, but the ECB thinks at the very least, at the earliest, it can only happen 6 months from now. Will they call for greater action by the EU Parliament on this in today's ECB press conference? Maybe. And if they do, what would be the impact of that? I wouldn't expect any impact out of it, unless, of course, the main stumbling block, Germany, decides to say, yes, we agree to an accelerated schedule. That said, let's move on to our charts. Again, I do not expect to have any rate action. We expect that interest rates will remain steady in the Eurozone. We do not expect to see any more quantitative easing ideas popping up out of the ECB. The necessary plans, the necessary facilities have already been put in place. So, in short, guys, if there's anything that's new in the release, it could be market moving, and it could probably mean that we should be looking for a weaker euro. That said, let's again move to our charts. Let's take a look at our EUR-USD itself. We've had a big sell-off across the asset classes yesterday. Some people say it was because of Mario Draghi. I personally think that that was just Wall Street crowd feeling sorry for themselves when I already forgot his name, when Mitt Romney lost the elections. I can't believe this guy's in Wall Street. The Obama victory will probably mean that Wall Street will have to pay higher taxes. But if you think about it, Obama's policies since he came into the presidency have actually made the rich even richer. Okay? So they're going to get taxed more. But all their losses that happened in 2008, that has been recouped already. They've been made whole for their losses. It's only the small fry which are still staying out of the stock market. Okay? But the rich guys, they're back and they've money out of the stock market already. So again, I view yesterday's collapse in virtually every asset class. You know, yesterday was so strange. Stock market was down, commodities were down, from base metals to energy to oil to precious metals to food. They were all down yesterday. And even the bond market was down. The only other time when I saw something like that was in right after Lehman, when basically the banks stopped trusting their counterparties, when everybody just withdrew from the market. So Um, we had our big sell-off. What happens going forward? Typically, when we have a big sell-off like yesterday's, and you really did not have any change in the fundamentals, which we did not, you end up with markets just consolidating, if not pulling back. I tend to think that given the kind of breakouts that we saw, our likely move next will be consolidation. So for today, I'm thinking we will probably just consolidate in our euro. But let's take a look at the big picture. And what's the big picture for euro, guys? If you look at it, you have this symmetric triangle breakout in euro. And with that symmetric triangle breakout, I tend to think let's get more follow-through weakness. Again, as far as the ECB decision is concerned, I do not expect to be surprised. So I'm not going to focus on, I'm not going to belabor that event. It's not likely to surprise us. And even if it is, any surprise out of the ECB will probably mean that you're going to get a weaker euro. So we have a symmetric triangle breakout. Our price target for that symmetric triangle breakout calls for prices dropping all the way down to your 25.50s area. As far as today's trading is concerned, we have had 56 pips of price action. Average daily range is 86. The projected low for euro is at 26.90. If I look at my charts, I have a minor support out of 26.97. So I'm thinking my objective could be to get to that 26.97 area. But can I actually do that in a market that we said would likely just congest? So let's take a look at this from an indicator's perspective. What are we being told? Hey Ahmed, yeah, Greek vote has no effect. Let's put it this way. It was highly unlikely that they would say no. Otherwise, the country would have run out of money by next week. So it is totally expected by the market. And you know, these days, Greece is not really an issue. Let's put it this way, guys. The debt of Greece, in theory, can be paid over and over every year by Germany as long as the German economy is doing okay. The stuff that the Eurozone cannot afford is a Spanish default situation or an Italian bailout situation. That's what the Eurozone cannot afford. But Greece, if they really want to, they can afford to solve Greece's problem if the politicians are willing to kill themselves in the next election, are willing to lose the next election. So, Euro, we've got a bearish view from our indicators. The only problem that I have really is that we've had a big sell-off yesterday without a real fundamental catalyst behind it. The only reason that the market sold off yesterday for me was you had the Wall Street people sour graping for Mr. Obama's re-election. We go intraday, what are we getting in euro? You have a mixed view. Your stochastics are rising, MACDs are down in the 4-hour level. You go hourlies, and what do we have? More mixed signals. In the process of crossing up in stochastic, your MACDs are heading lower. So what's the plan for us? Previously, I viewed our euro as having a strong resistance, a strong support at 27.54. I'm now looking at it as a resistance level, a significant resistance area. So you give me that 27.54 region, and for an intraday trader, I'll be Etienne, thank you. For an intraday trader, I'll be joining the short side of your euro from that 27.54 region. I'd look at possible stops above 27.83. Again, going forward, we don't have any good news from the Eurozone, and we've managed some pattern breakouts, that our focus now will be on trying to squeeze that pattern breakout some more, and that means pushing under 27.54, maybe making a run to your next key support at 2626. Although I'm not ambitious enough to look for your pattern objective of 25.49, 25.50. So we are bearish in euro. We're not in a hurry to get it to sell off. Unfortunately, I cannot read this article now. Let me save that. Let me open it in one of my windows. But I can't read it and do the class. So I'll read it for my own consumption after our session. Let me go to some other chart, guys. Something that I really, really like. GU, okay, we'll take a look at GU after. Hey, gangster, I'm doing okay. But let me go to that chart that I really, really like, and then we'll take a look at your cable. So what do I really, really like right now? It is this chart. What's to like about your EUR-AUD? We've had a descending triangle breakout, yes, but we've also seen the target of your descending triangle breakout already. So from the perspective of, can I get my pattern objective? We've already had it. But one of the things that I'm keen, or I'm looking for over the next few weeks or so, is for the Australian dollar to strengthen. Remember that lately we've had good data from Australia. We were surprised when everyone was saying that the RBA will cut rates. The RBA decided not to cut rates. Okay. Numbers coming out of China has been improving, which means that Australia will benefit, which means that the currency is likely to strengthen. From a technical perspective, your Aussie, your AUD-USD, managed to push through a key resistance level at 104.11. And we closed above it. So from that perspective, one side of our EUR-AUD currency pair says you're going to go down. Now let's talk about the other side. We're talking about euro. And what do we expect? What do we expect from euro? We've just heard from Mario Draghi yesterday. And he said that even Germany is beginning to feel the impact of the Eurozone crisis. So from a Fundi perspective, what I am seeing are arguments that say that the Eurozone, the Euro in particular, is likely to weaken going forward. Well, I don't expect the ECB to cut rates, at least not tonight. Expectations actually call for the ECB to cut rates maybe in the first quarter, maybe around February or March. But yeah, this is a good pair to consider. This is not an intraday trade. This is more of a overnight trade, a couple of days in the market. But consider this. If we manage to close below your 50 fib retracement of that rally from August, we don't have a support to work with. Your next support is minor at 21.32. Below that, your next, I would say, good support is at 60.74. I look at it as a good support because it's a 61.8 fib retracement. But if I look at price action, we only have two highs that define that area. It's not that strong. And even a better support would probably be this level at your 1859 region. But I'm not greedy. I'm just looking for a short over the next couple of days, maybe a week or two, that could potentially take me to 61.8 fib, your 60.74 price point. And by the way, folks, as far as our EUR AUD swaps are concerned, if you're holding on to a sell in EUR AUD, you will probably get a positive swap. So this is more of an overnight, more of a full week or two of being in the market type of trade. But I look at EUR AUD and I'm thinking the potential for a bear market there will be pretty nice. Yep, it's a good carry trade. Okay, good carry trade. I just wish that I actually shorted this when we have that descending triangle breakout. But this wasn't originally my idea. Originally, someone from the FX Instructor trading room told me, hey, you've got a nice pattern in EUR AUD. Tian, that's a good question. I actually haven't seen how the stocks, how ASX 200 looks like. So let me do that. Let me take a look at ASX 200 before I open my mouth. Okay, let me just do this. ASX 200. We've certainly been trending lower in ASX over the last few weeks. And when I go weeklies, where are we? So we managed a breakout on a big scale before. Your 44.28 area. So the question is, can we hold above 44.28 now that prices are pulling back down a bit? What are the considerations? Chinese manufacturing has been doing well. Even US manufacturing is actually seeing a revival, although Australia doesn't normally benefit out of it. Let me do fibs. We are around 23.6 fib. All right, let's put it this way. If over the next 2-3 weeks we can stay above 44.28, I think your ASX 200 should be okay. This was a threshold moment here. that break of your 4428 area. So we are around the threshold. We actually bounced off it already. I see this as a possible buy on dips from that price point. If you compare ASX 200 with, say, your Dow, consider that in Dow, we have it at a new high since 2008. That's why I was saying earlier, those Wall Street guys are crazy not to love Obama. They may be taxed higher, but Obama made them rich. Okay? Look at this. Look at the sell-off before Obama. And look at the rally that U.S. equities have had since Ben Bernanke started printing money. And by the way, I would actually look at the Canadian dollar as probably more likely to benefit out from U.S. strength. Although I prefer trading Aussie to the Canadian dollar, given that your ranges in Aussie are a little bigger than that in Aussie, than that in Loonie. So I prefer trading Australian dollar because the ranges tend to be bigger compared to the Canadian dollar. But anyway, I was supposed to look at cable. I know we're supposed to cover the rate announcement, folks, and it's going to be out in about 3 minutes' time. I totally have no plans on taking any trade out of it. If we have any surprise announcement, it would probably be for non-sterilized quantitative easing. It would probably be for a measure that would provide liquidity. And it would, what would that imply? That would probably be a bad news for the euro. Let's take a look at cable. Earlier in the FXI trading room, we were looking at this and I was saying, if it weren't for the fact that market was so boring, it would have been interesting to try to do something about this hammer. I didn't do anything about the hammer because I thought, market is boring, we will likely see limited upside. What was the point of chasing 10 pips? And now I'm staring at this and I'm miffed with myself. That was actually a 50 pip rally up. But let's take a look at the overall picture for your cable. I look at cable and I tend to think we've had a lower high, lower low before, but that's over. That's done with. We've violated the pattern. Lately, we've also seen some good numbers out of the UK. Not good enough for us to expect your cable to rally past 6,300. Okay, after all, there are still problems that are that's faced by the UK, and some people would say that the recovery in GDP was due to the Olympics. Whatever the case, we have a recovery in GDP, and some of the numbers have been good. So what am I thinking? When you have a mixed set of numbers, look for a wide range play to ensue. So as far as cable is concerned, I look at this and I tell myself, why don't you look for buy on dips whenever you approach the 59.14 area? Why don't you look for sell on rallies if you find yourself pushing for the 61.75 region? At the moment, our daily charts suggest that bearish momentum has been lost. We may be generating bullish momentum soon, depending on just how the candle will close for the day. All right, folks, we should have that ECB announcement by now. I'm not seeing any news flash. There we go, unchanged as expected. Let's give it a couple of seconds. But I highly doubt that they will introduce any new credit facility. Again, the plans have been put in place, the packages have been put in place. It's now a question of are they going to ask for some money? Is Spain going to ask for a bailout? Thank you, Vicky. Well, Spain is not going to ask for a bailout. Why should they? Earlier, the Spanish government raised some money from the bond market. They had good rates. They were oversubscribed. Why go to the onus of having someone look over your shoulder all the time if the mere statement that the ECB is willing to fund the bailout is enough to lower the interest rate that the Spanish government is paying? So unless the ECB says free money if you want it, I don't think that Spain will be in a hurry to tap that bailout money that's been programmed for them. And okay, no announcement at all with respect to changes in policy. So I guess we'll have to wait for the press conference and see what kind of questions will be fielded and how Mr. Draghi would answer it. If I were at that press conference, I would focus on asking Mr. Draghi why was he talking about Germany taking a hit yesterday, about Germany being affected already by the crisis yesterday. I really want to gauge his response, his response to that question. Was he just reminding the German government? Was it for the benefit of the German government so that they can convince the public we need to take action? Okay, so let's get back to our charts. Again, a non-issue there as far as the announcement is concerned. So folks, as far as our charts are concerned as well, I see that we already have average daily range in cable. So I'm not willing to try to chase the buy side of this chart. But can I say you're near the highs, you have average daily ranges, can you short it? Can you reverse the bounce that we've had? Let me see how indicators look like. So we have a minor resistance at your 59.94 region. Our projected high is 1.6 itself. Indicator-wise, we have a mixed view in the daily charts. We have our 55-day EMA at 60.24. Well, Tien, I used an indicator that I have. One is fib weighted, and the other is basically just a 21-day average through range. So the number changes from day to day because the idea that I follow is you use which is whatever's bigger. If the 21-day average is bigger than the fib weighted, then I use the 21-day as my average range. If my fib weighted is greater, then I use it as my basis for what to expect for the day. But lately, on average, ranges have been terrible. I've been seeing them around 70 pips for most of your dollar majors. Last time I saw something like this, I think it was 2005. Hey Dudley, what's going on in Kiwi? Alright, so let me just settle our cable and then we'll go to our Kiwi. So as far as cable is concerned, guys, you've got mixed signals in the daily picture. If we close where we are, we're just above a minor resistance that we had. That might imply further gains in cable by tomorrow. But one thing I hate is chasing the market whenever, especially if I actually do not have any excuse for chasing the market. If there's no data that tells me the market is going one way or the other. And right now, I see no data that would justify me chasing the buy side of cable. So what we had was a technical rally, but if you close the day above 59.94, we may be able to look for a follow-through move, a test of 60.39, the way we had the highs at 60.39 in our daily candles before. Well, let's put it this way. I would advise that you choose a broker that charges commission instead of making their money out of the spread. The spreads can get you stopped out. Alright, let's take a look at Kiwi. So Kiwi is actually one of the, let me check my index. Yep, Kiwi is actually the weakest of the majors right now. What's going on? Basically, we were given, or we had, some very bad data from New Zealand earlier, before the open of the Tokyo market. New Zealand released its jobs data, and not only that, they cut rates before, but earlier we had, let me check the numbers. Earlier we had their unemployment rate shoot up to 7.3%. Their employment change numbers went down. They were expecting it to improve by 0.3. It went down to 0.4. So the combination, job losses, unemployment rising, that's the worst combination of your jobs data. The best combination is when you have unemployment going down and the employment change data going up. The worst combination is what we had. People lost jobs. They could not look for work. Maybe, Tien, maybe. But what's the implication for us? Your Kiwi has been stuck around this congestion for some time. That congestion is really very near our previous highs. What we have, the rate cut and then this jobs numbers, is probably enough for us to think in terms of, are we ready for that Kiwi to see a substantial change in value? Are we ready for your Kiwi to get out of this congestion to push under 8100? From the Fundi side, we have the argument to do that. Let me see what the charts are telling us. Daily indicators, you have a confluence of bears. Price action today is, well, I guess you have to count the sell-off from the Wellington session as part of today's trade. Because what happened was after your initial sell-off, you basically just consolidated. Intraday, what are we getting? Confluence of bears, lost bearish momentum already. Hourly's the same, You have a consolidation, although you're seeing lower highs. Indicator-wise, you actually have a confluence of buys. What I'd like to do is try to see how markets will respond to 81.64 tomorrow. 81.64 is a moderate resistance level. I know to get there you'll probably trigger a double bottom, but I think your double bottom from the hourly charts wouldn't be good enough to push through it. I'd love to get a rejection from there. If you want to play things safely, then try to catch a rejection from this area, your 82.32 region. But going forward, we will now, or I would, focus on getting that Kiwi chart to test 8100 again. As we said, the picture has changed. Okay, you had the rate cut, you've had bad data. There's no reason why our Kiwi should stay above 8100. You may argue that, hey, it's a commodity currency, and I will say it's an agricultural commodity currency. It's a soft commodities currency. Okay, so that's not exactly a hot item at this point. So Kiwi bearish. We may be at the brink of starting the next down leg, or at least a pullback towards your 78 90s area. Let me get back to overview. Wow. I am now very, very sorry for not taking that hammer seriously in your GU chart. Hey, Ahmed. Let's put it this way. Euro and cable, I was expecting that to sell off anyway. I was surprised with the Aussie sell-off. I'm trying to recall the reason for that. But as far as euro and cable are concerned, I tend to think that market is now thinking in terms of textbook. We have to remember that according to textbook macroeconomic balance theory, whenever you have good data for jobs, whenever you have good data, okay, let's put it this way. If you have good data for consumption, good data for jobs, good data for investments, your economy is doing well. And if the economy is doing well, the currency should be stronger. The reason why we used to say good jobs data, buy euro, buy cable, buy Aussie, buy Canadian dollar, buy everything, was because good jobs data meant that the stock market will rally courtesy of the free money that's coming from the Fed. But there's this idea now that your QE has really lost its significance as far as moving the stock market up any further, and that we should now go back to the textbook. And again, the textbook says good data is good for the currency of that country. Actually, there's really little prospect of QE4. We've just had QE3, and QE3 is expected to continue up to forever, at least until the housing market recovers. So I don't think of it as a QE issue. if you want a more cynical view, you can say that. Oh, sorry, guys. One cynical view that I had on Friday was the stock market, the market sold off because that NFP data virtually assured a re-election for Mr. Obama, and Wall Street did not like that. That was the cynical explanation, and part of me believed it for why we had that reaction. But textbook theory does say you get good data, you get a good currency. Guys, I've run out of time, so I'll just thank you for joining. Hope to see you Wednesday, or maybe next ECB announcements. Or you can join me at FXI at any time. It's a free room. So thank you for joining, everyone.